So, picture this. It's 2008, and the entire global financial system is having a heart attack. Trillions of dollars just gone. Banking giants, firms we all thought were invincible, are collapsing. And the world economy is right there on the edge of a cliff. Now, in the aftermath, everyone's looking for the culprit, and they found a lot of them. But there was one suspect hiding in plain sight, a single statistical tool used by pretty much every bank on the planet. A tool that was supposed to be a shield, but, well, it might have been the sword. I mean, just think about that for a second. It's a pretty chilling idea, right? What if the very thing that was supposed to be a financial seatbelt, that warning light on the dashboard, was actually slamming the accelerator, pushing us straight towards that cliff? That is the wild story we're diving into today, the story of value at risk, or as everyone calls it, VaR. You know, at its heart, the entire financial industry is really in the business of just one thing: managing risk. That's it. It's all about the fundamental uncertainty of the future. Are you going to get your money back? Is the market going to go up or down? Trying to tame that uncertainty, well, that's the name of the game. And it's not just one simple kind of risk. I mean, finance pros are constantly juggling all of this at once. You've got credit risk, which is someone not paying you back, liquidity risk, where you have to sell stuff at a loss, market risk, the big one, and even operational risk, just things going wrong inside the company. So you can imagine they were desperate for one simple number that could just tell them, okay, how much trouble are we in today? And that magic number was value at risk. And honestly, the concept is so simple, it's seductive. A bank could calculate its VaR and say something that sounded incredibly reassuring, like, okay, team, we are 99% confident that we will not lose more than, say, $10 million in a single day. It felt like control. It felt like you had a handle on things. But as we found out, it was just an illusion.
So if VaR was this illusion of safety, how did it get everywhere? Well, here's the truly shocking part. The fatal flaws in this tool, they weren't discovered in the wreckage of 2008. Nope. They were published, they were debated, and people were sounding the alarm in academic papers years before the crash. In a way, this whole crisis, it was foretold.
Just let that quote sink in. This is not from some hindsight analysis in 2009. This is from 2001, a full 7 years before Lehman Brothers went under. You had researchers flat out warning that this risk management tool could, by itself, create a crash. So the question is, how? How is that even possible? Well, the answer lies in this really powerful idea called endogenous risk. Okay, think of it like this: a thermometer, right? It measures the temperature in a room, but it doesn't change the temperature. VaR was totally different. It wasn't just a passive thermometer. The act of everyone using VaR to measure their risk actually changed the behavior of the market, which in turn changed the risk itself. It created a massive, dangerous feedback loop. And here's how that feedback loop created this just devastating downward spiral. So imagine the market dips just a little bit. Suddenly, the VaR models at thousands of banks all flash red at the exact same time, basically screaming, danger, too much risk. Now, because of regulations, they are all forced to sell the same risky stuff at the same time to get their risk levels back down. But what happens when everyone sells at once? Prices collapse. And that collapse, of course, makes the VaR model scream even louder. A tiny little tremor becomes a full-blown earthquake, amplified by the very tool that was supposed to protect everyone from it. And this whole thing points to the second fatal flaw. VaR had a huge blind spot, something we call tail risk. See, VaR is pretty good at telling you the odds of a normal bad day, but it tells you absolutely nothing about what happens on a truly catastrophic, once-in-a-generation kind of day. The analogy is perfect. It tells you the odds of your foot slipping at the edge of a cliff, but it doesn't tell you if the drop is 10 feet or 10,000 feet. Okay, so faced with these incredibly dangerous flaws, it was obvious the financial world needed a better tool. So academics and regulators started this quest for a more reliable way to measure risk, one that was built on a really solid mathematical foundation, something they called coherence. So what does it mean for a risk measure to be coherent? Well, the most important rule is something called subadditivity. And it's actually a really simple idea. It just means the risk of two portfolios combined should never, ever be greater than the sum of their individual risks. Basically, diversification, not putting all your eggs in one basket, should always help, or at the very worst, do nothing. It should never make things riskier. And here it is, the crucial point. As the mathematicians proved, value at risk is not coherent. It completely fails that subadditivity test. You can actually find two different portfolios where, according to VaR, combining them makes them look riskier than keeping them apart. And believe me, this isn't just some boring technical detail. It has massive, real-world consequences. So why does a technicality like that matter so much? Because if your risk measure isn't subadditive, it creates this really messed up incentive. A huge bank could literally break itself up into smaller legal entities, hold the exact same risky assets, and the total amount of money regulators required it to hold against losses could actually be less than if it was just one big firm. It's basically a mathematical loophole that lets you hide your true risk from everyone. So, what's the alternative? Well, let's introduce the hero of our story, a little something called expected shortfall, or ES. It answers the one question VaR completely ignores. Okay, we know there's a 1% chance of a really, really bad day, but on those bad days, what's our average loss going to be? It forces you to look beyond the cliff's edge and actually try to measure the drop. Looking at them side by side just makes the difference crystal clear. VaR asks, what's my likely max loss? But ES asks, if things go wrong, just how wrong do they go on average? And you can see ES actually accounts for that scary tail risk. And most importantly, check out the bottom line. It is a coherent, subadditive risk measure. It closes that dangerous loophole we were just talking about. Now, fixing the risk measure for a single bank was a huge step forward. But, the 2008 crisis taught us another really painful lesson. Measuring the risk of one bank all by itself is dangerously short-sighted. We had to start seeing the whole system. And that brings us to this idea of systemic risk. It's the domino effect, plain and simple. The risk isn't just that one bank is going to fail. It's that one bank's failure could pull down 10 others, which freezes up all the credit markets and causes massive damage to the real economy, where we all live and work. So in response, this whole new toolkit of risk measures came out, and it really represented a fundamental shift in how people thought about this stuff. So for example, you have a measure like VaR. It doesn't just ask how risky a bank is by itself. It asks a much smarter question. If this bank gets into serious trouble, how much does that amplify the risk for everyone else? It's about measuring the dominoes, not just the first one that's about to fall. But there's a little note of caution here. As researchers dug deeper, they found that some of these new, super complex models like VaR were actually kind of unreliable. Some studies even suggest that much simpler indicators, things you can just pull directly from market prices, can sometimes do a better job of flagging systemic risk. So, yeah, the search for the perfect measure is definitely not over. And all of this leaves us with a final, really crucial question. We've replaced a pretty flawed tool with some much better ones. That's great. But no matter how sophisticated the math gets, at the end of the day, all these models are being used by people. And people are subject to fear, to greed, and to that powerful herd behavior, especially in a crisis. So is the ultimate challenge really about finding the perfect equation? Or is it about understanding and trying to manage that flawed, unpredictable human element that's right at the heart of the entire system?